how landlords making $75,000 a year could end up in a millionaire tax bracket. In this episode, I'm going to address the question how Biden's proposed capital gain tax changes will hurt many people, especially those who own rental properties. Get ready. You may not be aware of these changes and how much they could damage what you have been saving and accumulating in your rental income properties. So my name's Doug Andrew. I've been a financial strategist and retirement planning specialist now for more than 48 years, but I've helped many people not only optimize their financial assets, but minimize taxes. And so many times as I meet with people across America to help them prepare for retirement, I have noticed that many Americans will draw from up to 4 income buckets where they've been accumulating money. Not everybody accumulates money in all 4 buckets, but I'm going to summarize these real quick, and then I'm going to show you the real estate one. Now, a lot of people, unfortunately, approach retirement and they're way too top heavy in what I call the investment bucket, money in yet to be taxed IRAs or 401ks. And they have too much money in those yet to be taxed accounts. And I would recommend that no more than 30% of your money at retirement, because at retirement planning is something totally different than maybe what you did for retirement planning. I would recommend no more than 30% of your money still be in that bucket. So this requires that during the final 5 years before retiring, that people perform what I call a strategic rollout, not a rollover. See, a rollover is going from the frying pan into the fire. This is where people take money out of 401ks and roll it over to IRAs, and they continue to postpone until they're 72, and then they're told to take out RMDs, or required minimum distributions. That's the worst advice for most Americans, in my opinion. The next bucket is real estate. Now, some people only own their home, but there's a lot of people who have non-owner occupied rental income properties, whether they're single resident rental homes, duplexes, apartment complexes, maybe commercial properties. Now, before I come back to that one, because that's what I'm going to focus on in this episode, some people have defined benefit pensions. They're a school teacher, a police officer, a firefighter, and so they have these guaranteed amounts. Some people just rely on Social Security, which I would consider Social Security to be a bonus, not the basis of your retirement, because frankly, Social Security is in trouble in this country. The government owes about $130 trillion in future Social Security and Medicare benefits, and they only have about a 9-month cushion of that. If they don't collect or withhold it from new workers, they'll be broke. So don't rely on Social Security as your basis. It should be just a bonus. My favorite vehicle is the tax-free bucket. And out of those, I prefer what is called the laser fund. And this is where a lot of savvy real estate investors will keep their working capital because it's tax-free. Now, when you own real estate, you get tax advantages. In a nutshell, when people buy a rental property, there are 3 big categories of deductions that you take on a Schedule E or maybe an LLC if you have it in that kind of an entity. And that's where you're writing off the interest on any debt you have or mortgage. And you're able to write off any of the maintenance and the repairs and so forth, but then you're able to depreciate it down. Well, the problem with that is you buy a property, let's say 30 years ago, and it was a duplex for $250,000, and you depreciate it down to where over 26, 27 years, whatever, you depreciate it down to just the value of the land. Well, that means when you turn around and sell it, you're going to have to pay a capital gain tax on what you sell it for over and above what you've depreciated it down to, and this is where people get bit. All those tax benefits that they enjoyed now catch up with them. And so what do they do to avoid paying the capital gain tax? They continue to go from the frying pan into the fire by buying like property and inheriting new headaches. They have to do 1031 exchanges. Now they have another property and they're still a landlord, taking out the trash, fixing toilets, evicting tenants. And a lot of them are pretty tired. They thought in retirement, oh, this is going to be my retirement nest egg. But they're really tired of managing. And I could tell you horror stories of many who then hire real estate managers, and many times those management companies embezzle money. They don't manage it as well as they did, and so people just go, I've had it. So they don't sell because they're going to have to pay a big capital gain. They painted themselves into this corner, and they think, well, if I hang on to these properties, when I die, my kids will inherit it, and now it's worth $1 million. There are many people who bought property for $250,000 30 years ago, and now it's worth $1 million. In California, I've had many people in the San Francisco Bay Area that bought homes for $230,000 30, 35, 40 years ago, and they're now appraised for $4.8 million. Well, you sell them, you have to pay a capital gain tax. So people hang on to them thinking their children will inherit them and get a step up in basis. Well, it sounds like President Joe Biden may want to get rid of that, and he may be successful. But he also, in order to fund his initiatives of Medicare for all and student loan forgiveness and free college tuition, and all of these stimulus packages, he's increasing income taxes, estate taxes, but one of the big ones is not only the corporate tax rate is a 33% increase. It went from 21% up to 28%. People say that's only 7% more. No, on every million, now corporations have to pay, instead of $210,000, $280,000, which is 33% more in tax. And this is why corporations, they can't afford that. They lay off people or they increase the price of their goods and services. But let's get back to this capital gains tax. A lot of times the capital gains tax, I feel, is unfair. I'm going to explain why next. Why would a capital gain tax be unfair? Because many times you're being taxed for inflation. When you sell a highly appreciated asset, if it's property, for example, it appreciated because of inflation. Inflation may be averaged 5%, and maybe it went up in value 7%. So 5 of the 7 percentage points was just the cost of living going up. And the government is taxing you for the cost of living increase. That's really unfair. That's why many times when you have a Republican who is in office, they will lower the capital gain rates down to 0 or 15 or 20%. So for example, I sold a commercial building under the Trump administration, and what a lot of Americans don't realize is that you sell the property, the capital gain is added on top of your income to calculate what income tax bracket you are in. People think, well, I'm in the lowest bracket, so I'm not going to move up to the 20%. No, your capital gain is added on top of your income, which forces most people sometimes into a millionaire status. So I had to pay 20% plus another 2.8% for the Obamacare. So capital gain tax rates under Trump were just about 23% federal and another 5% to the state of Utah. So I paid about 28%. I know, I experienced that on a commercial building. Now, under Biden, he loves to tax people when there's money being transacted. And so his proposal is, number one, to change it to ordinary income tax rates. The highest tax rate for couples making over $400,000, individuals making over $200,000, is 39.6%. So it's moving from 20 up to nearly 40, plus the 2.8% Obamacare tax. It's going from 23 up to what? 43 plus the state rate. He is basically doubling the capital gain tax rate, and that capital gain is going to force many people into a millionaire tax bracket. So I read an article in the Wall Street Journal that sort of inspired this episode. So this article grabbed my attention. It actually came out in the Wall Street Journal the last day of July in 2021. It was titled, How a Landlord Making $75,000 a Year Could End Up in the Millionaire Tax Bracket. This was authored by Rachel Louise Ensign, and she gave an example of how this gentleman had worked very, very hard to acquire these apartments, had been paying them down. He still had a mortgage on it, but this was his retirement. And all of a sudden, under Joe Biden's proposal, he realized that now if he sold these for a couple of $1 million, that he was going to be pushed into a millionaire tax bracket 39.6% plus another 2.8% Obamacare. He was going to be shelling out to the federal government about 43%, and on top of that, the state tax. And so it forced him into the highest tax bracket. He didn't realize that's what was going to happen. This is what I'm talking about. So the other part is, if President Biden does away with the step-up in basis on long-term capital gains, what does that mean, potentially? Now, if this is alarming you and you can think of somebody who maybe is in this situation, be sure and share this video. Click like, you can post a comment, but I would encourage you to subscribe to this Three-Dimensional Wealth channel. I post an in-depth answer to a financial question almost on a daily basis. Click on that little bell so you'll be notified every time I do post a new educational video. And stay with me a few more moments. To the end, I want to gift you a copy of my most recent best-selling book called The Laser Fund. And you'll see this is where many savvy real estate investors keep their money for liquidity, safety, and to earn predictable rates of return. Even if they choose to just sell their real estate, pay the capital gain tax in today's lower rates, and then they go, where do I put this money? They're shocked when we can create cash flow equal to or greater than the rental income they were experiencing from their properties, and they don't have to be a landlord anymore, taking out the trash, fixing toilets, and evicting tenants. Oftentimes they go, where have you been? They had their blinders on thinking that real estate was the cat's meow. So, what's this step up in basis? See, tax revenuers again, like to be there with their hand out when there's money being transacted. The estate tax, sometimes called the inheritance tax, is what they assess when people pass away, the husband and the wife, and leave behind assets to the children. President Biden is proposing they raise those from about 40%, 46, up to 67%, because they love to tax people that are sort of 6 feet under because they can't complain about it. What about capital gains? So many people have been hanging on to these properties. They've been doing 1031 exchanges until they die and their children inherit it and get a step up in basis. So going back to my example, if your folks bought a rental property for $250,000 30 years ago and now it's worth $1 million, and they die and they leave it to you, unless you move into that, especially in the state of California, you have to move into it or else you do not get the tax break or the step up in basis. And in fact, California will probably tax you on a capital gain on an annual basis now. But let's say that you're in other states and you think, oh, you hang on to it for a year and now it's worth $1,100,000 and you sell it. Under the previous law, you get a step up in basis. You would only have to pay tax on the last $100,000 that it appreciated since the day that you inherited it. When you inherited it, it was worth $1 million, you hung on to it, and now it's worth $1.1 million. You pay a capital gain of 20% on $100,000, that's $20,000. You could potentially, by doing away with the step up in basis on long-term capital gains, be forced to pay how much? 40% on the entire million. Because if they do away with the step-up in basis, depending upon your tax bracket and other factors, you could potentially go from paying $20,000 to maybe $400,000 in tax with one stroke of a pen if that legislation is passed. So if this is alarming you, what should you be doing? Unless you really love those rental properties, I would recommend you strongly consider perhaps liquidating those, selling them while the market is hot, paying the capital gain tax at a lower rate rather than thinking they're going to be lower in the future, and reposition the after-tax money into a portfolio of laser funds where you will be able to accumulate the money from that point forward totally tax-free. You can create tax-free income or cash flow that often is equal to or greater than the rental income on the properties, and you don't have to be a landlord anymore. And at the end of the day, when you die, every million would blossom to maybe $2.5 million. If I died, I'm 69, every million would blossom to about $2.5 million right now and transfer tax-free. That reimburses you manyfold for any tax you do pay by liquidating the properties. If this is intriguing you, claim your free copy of this book. It's 300 pages, It will show you how to diversify and create the foundation for a tax-free retirement. This side is about 200 pages that gives all the charts and graphs and explanations. When you turn it to this side, there are 12 chapters, and there's one in there specifically about real estate investors and why they use the laser fund as their working capital account and their repository when they sell highly appreciated properties, pay the capital gain tax, and where they invest what's left over into here. And you'll see how people generate cash flow, income that equals or exceeds what they were getting in rental income. Claim your free copy. Go to laserfund.com, L-A-S-E-R, fund.com. Click on the link below. Contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, and I'll fire out a copy for you. There's options also there to listen and learn, watch and learn. But this is the beginning of your brighter future. I don't want you in some horrible capital gain tax trap without you being aware of what's coming down the pike and what you could have done to prevent paying unnecessary tax.